Hi, I'm Philip Smith, financial planner with Tidepool Wealth Strategies, helping self-employed professionals and solopreneurs just like you cultivate resilience in your plans to retire well. This is the Financial Planning Podcast about money management, best practices for long-term growth, wealth-building truths and fallacies, successful retirement strategies, and more, where I'll be sharing concise, actionable retirement planning guidance. Welcome to the Financial Flow. Welcome to episode 20 of the Financial Flow. I'm Philip, and today we're wading into the tide pool of financial planning to explore a challenge that retirees often face: managing volatility in retirement. Retirement is the time to relax, but market volatility can bring unexpected stress. If your portfolio takes a hit during the first few years of retirement, it can drastically impact how long your savings last. Today, we'll break down strategies to manage this volatility and keep your financial plan steady, even in a storm. If you enjoy today's episode, don't forget to share, like, and subscribe. Your support helps others learn how to feed and strengthen their own financial ecosystem. Here's why volatility matters in retirement. During your working years, market volatility is an annoyance, but with time on your side, your portfolio has the chance to recover. Once you retire and start drawing down these savings, however, market downturns become a much bigger deal. This is because of something called sequence of returns risk. Imagine retiring, then immediately facing a market drop. Think 2008. While the market might recover, the money you withdraw during those down years is essentially gone forever, never to benefit from the recovery. You're locking in losses at the worst time.
Philip, are you saying retirees need to have a crystal ball for the stock market?
Not quite, no. My crystal ball has been broken for a while, and without it, I have no idea when the new parts to fix it are coming in. And while a crystal ball would be handy, it's more about preparing for the unexpected with smart strategies, something we'll get into shortly. Sequence of returns risk is a sneaky one. It's the idea that even if your portfolio had achieved fantastic returns while still growing, the order in which you experience losses or gains can drastically alter the outcome when you are taking money out. If you hit a rough patch early on in your retirement and you aren't prepared for it, it can derail your entire plan. Let's take a simple example. Two retirees have the same portfolio, but one retires just before a major market downturn, while the other retires during a bull market. That second retiree has the luxury of compounding those gains for years before they face a market slump. The first retiree, though, might run into serious trouble if they're forced to sell investments at a loss early on. Think of it in these terms. If the shares are worth less when you sell them, then you sell more shares to get the dollar amount you need. That leaves less shares of whatever you own in the portfolio when the market rebounds. Sequence of returns risk is essentially erosion. All investing involves risk, including the possible loss of the money you invest. There is no assurance that any investment strategy will be successful. But with that having been said, the first step in shielding yourself from volatility is diversification. This means not putting all your eggs in one basket. Stocks, bonds, real estate, cash, each reacts differently to market changes. For retirees, having a conservative asset allocation, do we know what asset allocation is? Essentially, we're talking about the placement of specific percentages of your portfolio in various investments. So a conservative, less historically volatile mix of bonds, cash, and income-producing assets can help buffer against market swings. Keep in mind that asset allocation is an investment strategy, and like any investment strategy, it doesn't guarantee a profit or protect you from loss. Likewise, it can't eliminate the risk of fluctuating prices or the uncertainty of returns. Asset allocation is often driven by complex mathematical models and should not be confused with the much simpler concept of diversification. Rebalancing, which is often part of an asset allocation strategy, may be a taxable event depending on the account that you are rebalancing. Before you take any specific action, be sure to consult with your tax professional.
Sounds like spreading the risk, kind of like using a hard drive, a portable drive, a flash drive in the cloud for layered data backup, just in case something crashes. Or coffee gets splashed on a laptop, right, Philip?
Just in case coffee gets splashed, hitting a little close to home on that one. You do need options, though. In other words, diversified choice so that one bad market doesn't spoil the whole portfolio. One popular way to manage volatility is through a bucket strategy. It's a popular option, but not one I personally deploy with clients. There are income buckets, tax buckets, needs buckets, quite a few different sets of buckets, which can be kind of confusing. I'll quickly reference the needs buckets. This involves dividing your retirement savings into multiple buckets based on time horizons. In other words, when you will need it. First, the short-term bucket. Thinking in terms of the next 12 to 36 months, safeguard these funds with low-risk investments like cash or short-term bonds to cover immediate expenses. Second, the medium-term bucket. About 3 to 7 years. A balanced mix of stocks and bonds helps you grow your savings without too much risk. And third, the long-term bucket, which would be more than 7 years. More aggressive growth investments like stocks can ride out market volatility and give you the potential for long-term gains. By withdrawing from the short-term bucket when the market is down, you avoid selling long-term investments at a loss. This gives those assets time to recover. Another powerful tool is being flexible with your withdrawal, something I'd refer to as a dynamic income strategy, and my preferred option when helping clients plan their retirement. We touched on this in episodes 18 and 19. When planning ahead, one thing to plan for is the years when the market performs poorly. Not if, but when. You want to build in the financial flexibility to reduce the amount you pull from your investments. For example, instead of a fixed 5% every year, you might scale back your withdrawal rate to 4%, or potentially less during a downturn. This is a place where you should have some prior planning before markets nosedive. It's never a matter of if, but when. I can't emphasize it enough. And it's why I believe having a cash reserve is a critical component of the portfolio. This strategy can make a big difference in how long your portfolio lasts, especially when combined with lower spending and tapping into safer income sources during tough times.
So, when the market's down, it's time to tighten the belt. Less filet mignon, more ramen noodles?
From filet to ramen feels a bit drastic. I'd say it's more like stepping down from organic to non-organic for some of the produce, or reducing eating out. It's really just small sacrifices in tough years, which can pay big dividends by preserving your portfolio's long-term health. Your portfolio isn't your only income source in retirement, and it doesn't have to be. Social Security, pensions, rental income, or annuities can all provide steady cash flow that isn't tied to the whims of the market. If you're self-employed, maybe there's a chance to keep working part-time, consulting, or even renting out a property to supplement your income.
Having multiple streams of income acts as a safety net, allowing you to avoid selling investments during a declining market.
Right. Getting short on time today, so let's take some action on this. This week, review your current asset allocation and consider how a bucket strategy might provide the balance you need. It's also a good time to think about how flexible you are with your withdrawals. Could you pull back in a down market? And finally, check if you have other income streams that could take the pressure off your portfolio when volatility strikes, because it will. All right, that's it for today. Thanks for tuning in to this episode of The Financial Flow, brought to you by Tidepool Wealth Strategies. Until next time, stay resilient and plan to retire well. It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purpose. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and do not represent Tidepool Wealth Strategies or Cetera Advisor Networks, LLC. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities and advisory services are offered through Cetera Advisor Networks, LLC, a broker-dealer, registered investment advisor, and member of FINRA and SIPC. Cetera is under separate ownership for any other named entity. Whew.